Recording in progress.
Hi everyone, welcome to the Contra Costa County Student Wellness Series. We are so excited to welcome you to the Financial Competency, Fluency, and Wellness presentation.
Some quick logistics before we begin. This presentation is being recorded. However, for all the attendees currently listening, you are muted and not on video, so don't worry about making an appearance. Another important thing to keep in mind is this webinar will be made available to everyone, so you all will have the access to the information that has been shared today. Other types of logistics that we have are that if you have any questions, please submit them in the Q&A box. We will monitor them throughout the presentation, and we will have Q&A times following the presentation. We'll also be using the polling feature during this presentation to allow us to gather anonymous feedback from all of you. Finally, we'll be providing a bunch of resource links through the chat box. If you aren't able to access them through the chat box, don't have any worries, because they will be sent out to all attendees via email following the presentation.
Hi, I'm Cece. I'm a 10th grader in Contra Costa County, and my pronouns are she, her.
I'm Drew. I'm an 11th grader in Contra Costa County, and my pronouns are he, him.
Hi, I'm Mina. I'm an 8th grader in Contra Costa County, and my pronouns are she, her. Next slide. A little about Courage. Courage was established through a partnership between the Contra Costa County Office of Education and the Center for Human Development. Courage is a youth advocacy coalition comprised of 30 students ranging from 8th graders all the way to 12th grade from all over Contra County. Courage is a youth-centered and interactive leadership and advocacy group working to address issues around prevention of youth tobacco, marijuana, prescription drugs, and alcohol use and abuse. We use our voices to educate and present to local decision makers, youth conferences, and parent events, and we support annual countrywide PSA contests and film festivals. Courage is accepting new students' application each spring for the following school year. We will be accepting soon, so keep an eye out for that if you would like to join.
I want to thank our host and sponsor, the Contra Costa County Office of Education. CCCOE is an essential part of Contra Costa's outstanding public school system. Together with their 18 school districts and numerous community partners, they prepare students in Contra Costa County to learn, lead, and achieve. Providing support services to schools and school districts, CCCOE has a long history of providing direct services to some of our county's most vulnerable students. CCCOE also serves as an advocate for education and youth in our community, helps to increase public awareness of educational issues, and leads the way with bold countywide initiatives.
All right, we have the honor of introducing Jessica from Travis Credit Union. Travis Credit Union was founded in 1951 by military and civilian workers at Travis Air Force Base in Fairfield, California. Hi, welcome, Jessica.
Thank you. Thank you for your introduction. And hello, everyone. Welcome to today's webinar on understanding your money. My name is Jessica Leal, and I'm a Community Engagement Officer at Travis Credit Union. At Travis Credit Union, our staff and board of directors are dedicated to building lifelong relationships with our members to help them achieve their financial goals. And one of our primary goals is to share our awesome cause with you through our expertise on financial education and literacy. Next slide, please. And today we're going to go over a few topics, and they're basic budgeting, savings and checking accounts, the difference between a bank and a credit union, and understanding your credit score. Just a reminder, we'll be answering your questions until the end of the presentation, but feel free to use the Q&A box to continue submitting your questions through the presentation so that you won't forget. Next slide. So income, before we get into budgeting, let's start with income. In order for you to plan your finances, you need to have some sort of income. Some of you may already have a job, or you're receiving a paycheck. Others of you might depend on an allowance from your parents, or maybe even just depend on getting gifts during like special occasions like your birthday or graduation or whatever it is. But income is money that you're receiving, and it doesn't necessarily mean that you need a steady job. Since we're talking about income, I want to also mention taxes because they do affect your income. For those of you who already have a job, you may already know the difference between gross income and net income. Gross income is your full paycheck. So basically, when you getting a paycheck before taxes. So basically what it means is that, for example, if you have a job and you're getting paid $15 an hour and you work for 10 hours, you're expecting to get a check for $150. But that's not always the case. The reality is that every person who earns money working in the United States is supposed to pay federal income taxes. You're also required to contribute to Social Security and FICA. FICA stands for the Federal Insurance Contribution Act and is deducted automatically from your paycheck. And as you work, you pay FICA taxes, and those earn you credits for your Social Security benefits. Most states also charge you a state income tax, so that just keeps also getting deducted from your paycheck. So what that means is that at the end of the day, you're not going to get that $100, $50 check that you were expecting because you will have to pay these taxes and you'll get a smaller amount. And that amount is called your net income. That's your take-home income. So going back to those $150, at the end of the day, you're probably going to get a paycheck for $130. That's going to be your net income. I was very unfortunate that I didn't really pay attention when I was in school, or maybe I never got taught this. So I was expecting, when I got my first paycheck, I was like calculating it. I'm like, oh yes, I'm going to get like $500. And then when I saw my paycheck, I'm like, wait, what happened to the rest? And I saw these deductions. I'm like, who took my money? Why would you do this to me? I already had plans for all this money. So unfortunately, I learned the hard way, but now that you have this information, you'll be prepared. Don't think that you're going to be spending all that money because taxes will be deducted from your check. Next slide, please. So now that we've covered income, let's talk about budgeting. So the next step in creating your budget is for an income that you want to live within your means. One rule that you want to follow is that your expenses should never be more than your income. And following this rule will also help you keep you out of financial troubles. Always spend within your means, which means that you must think about how much money you have coming in and don't spend more than that. When budgeting, you also have to keep track of your money so that you know exactly how much money you have. If you have an account, this means checking your balance regularly. If you have money in your wallet, that means checking your wallet before you walk into the store to shop. Next slide, please. And when you're budgeting, your expenses will fall into 3 categories. You will have your fixed expenses, your variable expenses, and your discretionary expenses. So your fixed expenses are the same every single month. They never change. And those are, sometimes rent stays steady, mortgage, your car payments, insurance. For the most part, they're always the same. There's also variable expenses, which are also required for basic living, like groceries, gas, utility, clothing. Those vary every month. Like when you go to the grocery stores, vegetables tend to change in pricing, your meats, everything will change. So you're not really sure, how much you're going to be spending specifically on food. There's also discretionary expenses, and these are for the non-essential items that you can refer to as wants. And they're like eating out, going to the movies, subscriptions, or having clothing that's beyond what is really needed. So like, for example, having your outfit for prom, that would be something that you're not going to regularly be wearing a nice fancy dress or or suit on a day-to-day, but it's something that you would want to buy. Next slide. I think we skipped a slide. Can you go back to the previous slide, please? The 50, 30, 20. Oh, it's no longer there. Okay. So let's do a quick poll since it already got launched. And so I want to know if you already have a savings account or a checking account under your name. Okay, we're going to give folks a couple of more minutes. This is great. I'm looking at the results and it looks like most of you already have savings accounts. So that's great, or a checking account. Couple more seconds. So the poll is closed. And it looks like 80% of you already have a savings account or a checking account. A couple of you might not have an account, or you have your parents saving for you, which is still good. I'm really glad that you have that opportunity to have someone hold your money for you. And the reason why I'm asking this question is because, moving to the next slide. I'm going to tell you the difference between a bank and a credit union. So having a safe place to save is really important, and you want to make sure that your hard-earned money doesn't get lost or stolen, which brings us to the difference, a discussion between the difference between a bank and a credit union. Knowing where to bank is very important too. It's like shopping around, like you want to get the best deals, you want to get the best services that you can. So it's good for you to do some shopping around. And you want to make sure that your money is safe and you're getting the best return on investment. So there's two different types of financial institutions. There's many, but the two most popular ones, or the largest ones, are banks and credit unions. Banks and credit unions offer the same type of services like savings accounts, checking account, loans, certificates of deposit, credit cards, and other services. But the main difference between a bank and a credit union is that banks are for-profit and a credit union is a not-for-profit financial institution. And I'll explain why that matters with this visual. So let's start with the banks, the big banks, which is on the right side of your screen. If you look at you at the bottom of the screen, you are a customer. And a customer is an individual that purchases another company's goods or services. So you're paying for a service, right? Banks are owned by stockholders. So it's in their best interest to make lots of profits to keep their owners happy. The profits are also distributed to the board of directors because they're paid to sit on the board. The board of directors are those who are making important decisions for the bank, and figuring out how much interest rates you're going to be getting, or the fees they're going to be charging. So they're the ones making decisions for all the customers in that bank. The board of directors, just note that they're not required to have an account at that bank. So any decisions that they're making might not even be affecting them personally. When it comes to opening a savings account, obviously banks will give you interest rate of a small amount of interest, which is good. It's free money that your bank or that your account is earning, that your money is earning for sitting there and for you utilizing their services. And who doesn't want free money, right? However, sometimes, or something to keep in mind is that banks are available for anyone to open an account. So you don't even know how they're spreading, their profits, who's benefiting from it. People all over the world are getting profits, right? Or interest. So anyone can benefit from it. Now let's look at the credit union side. When you open an account at a credit union, you become a member, not a customer. So being a member means that you own a share of that credit union. So you're actually a part owner of that credit union. And because credit unions are not for profit, any profits that gets made, it gets returned to all the members through dividends. And that's why all credit unions offer better rates when it comes to savings accounts and loans. Another important thing to note is that the board of directors are volunteers, so they're not getting paid to be making important decisions for the credit union. And they're also required to be members of the credit union. So any decision that they make will also impact them. So obviously they're going to be making decisions that are going to be in their best interest, right? Or for the entire organization. Credit unions serve local communities. So to become a member, you have to be associated with whatever servicing requirements they have. For example, Travis Credit Union, and that's the credit union that I work for, you have to live, work, worship, or go to school in the 12 counties that we serve. So we're county-based. And there's other credit unions out there like Teachers Credit Union, Police Credit Union, that they're associated to those organizations. So you either have to be a police officer or a teacher or have a relative who is. So those are the differences. And because credit unions are local, they benefit you as a member, but also your neighbors, because you have to live in that area to become a member. So for example, let's say that your neighbor decides to get a business loan to open a grocery store. They're going to open that grocery store down the block from you or in your neighborhood, and you'll be able to benefit from that because you'll be able to shop there and shop local. And at the end of the day, the profits stay within your own community, or at least the people that you associate with the most. Now that you know the differences between a bank and a credit union, you'll be able to make informed decisions when it comes to opening an account. And that takes us to our next slide, the account opening slide. All financial institutions are different and they require different documentation when opening an account. But in general, they all ask for a valid identification. Some financial institutions require a state ID, passport, or any government issued ID. And some may accept your student ID as a form of identification. Your social security number is required. And if you don't have one, you might be able to also open an account using your individual taxpayer identification number, so your ITIN. You may need a parent or guardian on the account. Again, each financial institution is different and they have different rules and requirements. So it's really important for you to do your own research before you go into the financial institution. I know that at Travis Credit Union, if you're 14 years old, you could get a checking account under your name without having your parent without having your parent on the account. You just need to have your parent or guardian sign a letter authorizing you to have full ownership of your account. And of course, you need some money to be able to fund your account. And each financial institution has different minimum requirements. Some require $100, another $20. With us, it's only $5 that you need to be able to establish that account. Next slide, please. Now I want to talk about checking accounts and savings accounts. So those are the two most common services that you'll be able to attain as a teenager. The savings account and checking account. Checking accounts are for everyday needs. They're also called transactional accounts because you can deposit, withdraw as you please on a day. The same day, you can make a deposit and withdraw like 5 times from it. For savings accounts, they're for longer term needs and savings goals. So there's restrictions on how many times you can withdraw a month from these accounts because again, the purpose is for you to be saving. And there's actually a federal rule that you can only withdraw 6 times a month from your savings account without getting penalized. Anything after that, obviously it's your money and you are free to withdraw from it, but they will charge you a fee if you do it more than 6 times. You can open a savings account for college expenses, for your 18th birthday party, a down payment on a car, or maybe an apartment that you might be interested in getting after you graduate from high school, or even to like save for things that you want to buy in the future, or concerts that you want to go to, or even just to have it there for emergencies. If you're younger than 18 years old, you need to have an adult joint owner on the account. And again, like I said, each financial institution requires have different rules and requirements. So make sure that you are aware of the requirements before you walk in and open the account. Next slide. So now I want to go over ATM cards versus debit cards. They're different types of cards. So I want to make sure that you're really understand the differences. So an ATM card is given when you open a savings account. So it's only linked to your savings account. And you can use your ATM card to make withdrawals, deposits, transfers in the ATM machine. But again, this is only linked to your savings account. And again, you could only make less than 6 withdrawals a month. With a debit card, this one is linked to your checking account. Again, it's a transactional account, so you can withdraw, deposit as you please. So there's no restrictions there. And you can make purchases at the store. You can withdraw money at the ATM. And it also comes with a Visa logo. Most of them come with a Visa logo. That does not mean that it's a credit card. It's still linked to your checking account, and you're responsible to make sure that you have the funds before you make any purchases. Some tips to managing your ATM card and your debit card are, number one, you want to memorize your PIN number and never share your PIN number with anyone. You need that PIN number when you're making transactions or when you're at the ATM, because it's a security level to ensure that you're the owner of that card. And you wouldn't want anyone to just have access to your money and withdraw all your funds. So that's the reason why you want to keep that information private. Number two, never share your card. Again, it's your money, and you have to be careful with it. You don't want people to just automatically just use your card and use your money without your authorization. And keep your cards in a safe place, and contact the financial institution immediately if it gets lost or stolen. You want to make sure that they're aware that you lost your your debit card or your ATM card, and they'll send you a new one. Next slide, please. Now I want to go over a couple of tips for you to manage your account. Number one, keep track of your deposits, checks, ATM withdrawals, and fees, or anything that you're doing within your account. And check your account regularly to make sure that you're not a victim of identity theft. And also keep track of how much money you have as well before you make any purchases. So just FYI, sometimes these crooks that are out to get your money, they have nothing else to do. Honestly, they spend their whole day just trying to figure out how they can hack people's accounts. So what they start doing is, if they get a hold of your account number, your debit card number, whatever it is, your name, they start tapping into your account. And they might start just by withdrawing a couple of pennies. Who's going to notice if there's a penny missing when you're just looking at your balance without looking at your transaction history? It's going to be very hard unless you're like really remember exactly how much money you have. So if they start taking a couple of pennies here and there and you don't notice, you don't report it, at the end, once they have realized that they have full control of your account, they will take all your money. So that's why it's really important for you to keep track of everything, continue checking your account regularly, and also don't use public Wi-Fi to connect to your account. Whenever you're looking at your account or any bank transaction that you're making, don't use public Wi-Fi. Make sure that you're using a safe and secured network. And again, with today's technology, every financial institution has their own app. It's very easy for you to just go online, click on the app, look at your phone, click on the app and see your balance. So there's no reason for you not to do that regularly. Another tip, don't bounce checks. And bouncing checks means when you basically give someone a check and you don't have the funds in your account. Again, track how much money you have in your account before you mail the check, because bouncing checks you will have to pay a fee for bouncing checks, and it will ruin your reputation with the financial institution because they won't trust you anymore. They're gonna be like, wait a minute, you're writing checks and you don't even have the money. So think of it as giving a friend a fake $10 bill, and you give it to them, they go to the store, realize it's a fake bill. Are they going to trust you again next time you give them cash? Highly doubt it. They will verify, they'll probably pull out the marker and mark the bill and make sure that you are giving them a real bill. And it's the same situation with a financial institution. You don't want to break that trust with the people that you're banking with. They have your money, so you want to make sure that you trust them and they trust you. And also, bouncing your checks will put you into what they call check systems. Check systems is also a organization that every financial institution works with to verify what kind of a banker you are, or a customer or member. So if you have a bad reputation, it will show in check systems, and it'll be more difficult for you to open an account somewhere else because they'll see your record. Use overdraft protection to avoid paying overdraft fees. If you're a person that you feel like you can't trust yourself, you might, not check your account before you make a payment, then it might benefit you to pay that overdraft protection. There's usually a fee that gets associated with that, but make sure that you're aware of what that fee is also when you're opening your account. However, there are some accounts that some financial institutions have that will not allow you to make purchases if you don't have the funds. Like, for example, we at Travis Credit Union, we have what we call the Access checking account. So if you don't have the money, the transaction will not go through, which is perfect, right? Because you don't have to pay the overdraft protection fee, and you won't have to pay overdraft fees if you do overdraw. However, it might be a little bit embarrassing if you're at the store, you don't check your balance, and you realize that your transaction gets declined and you have to walk away with nothing in your hand. But at the end of the day, you are saving money because it's not going to go through if you don't have the funds. The other tip is to use apps or receipts to keep track of your spending. Again, I can't stress this enough. Keep track of your money. Download the bank app so you know exactly how much money you have and you can check it at any time. And there's other applications that you can download that will help you keep track of your spending. Like, for example, there's mint.com that you can link all your accounts into that one centralized location, and it'll alert you, it'll send you alerts like, hey, you've overspent, because you can set budgets, on entertainment, on gas, or whatever it is. And it'll send you reminders like you're getting close to your limit, you should be careful, or whatever it is. However, just keep in mind that, you are providing a third party with, your personal information, because you have to link it with your financial institution. So you have to be very careful. Make sure that it's a legit app before you put in any information into it. Report any suspicious activities on your account. Don't be a victim of identity theft. And please report it immediately to avoid having to go through a headache of recovering your funds. If you notice there's a transaction that you didn't make, doesn't matter if it's 2 cents or $5 and you don't think it's that much, regardless, still report it, because someone has access to your bank account and they will continue taking money out if they can, if you allow it. And then let's go to the next slide. Let's do another poll, and I want to see if what do you think of credit? Is credit good or is credit bad? This is interesting. So we have some that are saying it's good, some that are saying that it's both. Some are not sure, which is great, because if you're not sure, I hope this presentation will give you a little bit more information and teach you why credit might be good or bad. I'm not going to give the answer. Awesome. So it looks like we have like a tie between good, both, and not sure. Okay, let's move on to credit. So what is credit? Credit is the amount of money that you could borrow. So if you have a credit card with a limit of $500, the amount that is the amount that you are that you have available, your credit that you have available. And credit is used to make purchases and services that you might need, like, for example, mortgage loans, auto loans, student loans, and even credit cards. Those are different types of credit. When you borrow money, you borrow an amount, but there's also a fee that gets associated and that you have to pay the lender for letting you borrow that money. And that is called interest. So they charge you a percentage of money for lending you. And unfortunately, that's the way things work, unless you have someone that really trusts you and will lend you money like cash and not charge you interest. But when it comes to the real world and you have to get a big loan for an auto loan, again, mortgage loan, those are, thousands of dollars, you will have to pay interest. So you have to pay the money back. So that's what credit is. Now let's move on to credit scores, which is the next slide. So a credit score is a number that lenders use to help you decide, or to help them decide if you're likely to repay them on time. So that's why you have a credit score, because they want to know if you're someone that they can trust and that you will pay them back. So the most popular scoring system is called, that most lenders use, is called FICO. And that FICO score ranges from 300 through to 850, 300 being the lowest credit score and 850 being the best score available. FICO stands for Fair Isaac Corporation. So just in case you were wondering. So if you have a bad credit score, it is very difficult for you to get a loan because lenders don't trust that you'll pay them back. If you're able to find a lender that's willing to give you a chance, they will charge you high interest rates because they want to be able to get some sort of money out of you, regardless if you pay them or not. If you have a good or best credit score, you're not considered risky, and they will trust you because they think that you'll pay them back. That means that you have a good reputation paying back, and they're willing to do you a favor, lend you the money, and even help you save some money too, because they will not charge you a large interest rate. You want to make sure that your credit score stays in the high 700s, 800s, so that you're able to take advantage of the best interest rates and save money. So now that you know the ranges of the FICO score, let's look at how your score is determined. So FICO has not revealed the complete formula that they use to determine the scoring system, but they've provided percentages that will help you identify or figure out what is impacting your score. So for example, 35% of your score is determined by your payment history. So making payments on time is very important. And your FICO score tends to put a greater emphasis on the most recent 2 years. So what that means is that, a late payment that you might have done 3 or 4 years ago is not impacting your credit score as heavy as a late payment that you might have done like 3 months ago. Amount owed is 30% of your score, and the amount of outstanding debt that you have has a strong impact on your score. So carrying high balances, especially those closer to the credit limits, can lower your score. So the best rule to follow is to keep your balances at 30% of the limit And which means, let's say that you have a credit card of $1,000, you don't want to charge more than $300 on that credit card. The length of credit history is 15% of your score. And the accounts that you've had for more than 2 years will be more positive, impacting your score than the newer accounts. So it's like having a friend that you've known since you were in kindergarten. Chances are that you already know where they live, you know their family, you might even like call each other cousins or whatever it is, and you're more likely to know if they will pay you back the money that you lend them or not, right? Versus someone that you might have just met, maybe a couple of weeks ago. You don't know anything about them. You have no history. You don't know if they're gonna pay you back. So you're a little unsure if you want to trust them or not. So it's the same scenario. The longer you have a relationship with a creditor, the better it looks. The other one is new credit. So that's 10% of your credit score. So the number of inquiries or credit applications that you make are factors in your credit score. So don't apply for many loans or credit cards at the same time. Every time someone pulls your credit, a few points get deducted from your credit score. The last thing is the types of credit used or mixed credit. That's 10% of your score. And the different kinds of accounts that you have will affect your FICO score. And what that means is that, let's say you have a mortgage loan or installment type of loan, a service loan, like, a car loan or a cell phone bill. Those are different types of credit. So if you can demonstrate that you are able to handle different types of credit, then it will help you, it will increase your credit score. Next slide. So now that you know the differences between a good credit and bad credit, I'm going to also explain it with a car loan situation. So in this example, let's say that you and your friend go to the same dealer and you decide to buy the same exact car, same model, same year, same color, same everything. The only difference is that you have good credit and your friend has bad credit. So let's look at the example on the screen. Your car will cost you, let's say it costs you $20,000, and you decide to get a 5-year loan term. And your friend does the same exact thing, $20,000, 5-year loans. The difference is that you're getting an interest rate of 6%, and your friend, because they have terrible credit, they'll get 26% interest rate. After all the calculations of your monthly payments, after all the calculation, your monthly payment will be $387, and your friend's monthly payment will be $599. That's a difference of $212 that your friend will have to pay extra. And when you're calculating the interest itself, you will be paying $3,199, and your friend will be paying $15,929. So that's actually another car they can buy just on the interest that they're going to have to be paying on that vehicle. So that's huge. And the difference again is that interest rate, because your friend has terrible credit and you have good credit. So again, same loan term. The only difference is the interest, the monthly payment due to the interest that you're going to have to pay because of your credit score. So that's why credit matters. And it's really important that you have a good credit score when you're borrowing money. You want to make sure that you get the lowest rates on loans and the highest rates on savings accounts too. And since we're talking about auto loans, I also want to let you know that if you make one late payment on a car loan, it can drop your credit score up to 100 points. So if you're already, like, let's say you're in the 600 range and you make one late payment on your car loan, it can drop you to the 500s. And again, going back to that scale that you saw a couple slides ago on the previous slide, that will put you in the bad side. So you don't want that to happen to you. So make sure that you pay on time. Next slide. So we're coming to an end of my presentation, but before I end, I do want to give you a couple more tips when it comes to maintaining good credit. When using a credit card, never charge more than what you can afford. And also, like, so try to pay your bill on time, on full balance, so that you don't have to pay interest, because that's what happens. So you get your credit card, you use it, you charge $200, 30 days later, you'll get a bill on your, to your house for those $200. So what you want to do is pay it in full, and you will avoid paying interest on that loan. If you do have to, for whatever reason, keep a balance, always pay more than the minimum balance. Minimum payment, because it'll help you pay off quicker and also save you some money in having to pay interest. So make sure that you're paying more than just the minimum. Pay on time. Don't forget that 35% of your score does depend on the payment history. So paying on time is key. Limit the number of credit cards. So having maybe 3 to 5 credit cards is a decent amount. You don't want to have more than that, because you can easily put yourself into a lot of debt by having too much credit available. And again, don't max out your credit cards. Try to keep them at that 30% of the credit limit. The other tip is to keep your cards private and safe. Again, you don't want anyone to have get a hold of your credit card, because they could end up using your card and using your money without your authorization. So keep it in a safe place. Last but not least, start building credit with a secure credit card. And a secure credit card is a type of credit card that is backed by a cash deposit from the card holder, so from you. The deposit acts as a collateral to the account, and it provides the card issuer with security that, in case you were to default on that card or you can't make the payments. And because you probably don't have any credit history, starting with a secure credit card is the safest thing to do. And you can start a secure credit card with $500, and some financial institutions offer a $250 dollar card. So that's a very low amount that you have to put up front. So that I really recommend that if you don't have any credit history, start with a shared secured credit card. And that concludes my presentation. I hope you enjoyed the presentation and that you got really good information. Again, we'll be doing the Q&A at the end. So feel free to, put in your questions in the next couple of minutes. And if you want to visit our website, we also have other webinars available specifically for youth, and the link will be put in the chat, so you can look at our page and watch other videos that are related to financial education. And if you do have additional questions and they're more personal, you don't feel comfortable putting them in the Q&A today, feel free to send me an email. My email address will also be in the chat as well. And it's jleal@traviscu.org. And now let me turn it over to Nicole.
It actually is going to Cece.
Sorry about that. I had some Wi-Fi issues. Thank you, Jessica. That was great. We hope you all enjoyed it too. We'd really like to get your feedback on this session. Please scan the QR code or use the link in this chat box to complete the confidential survey.
And we want to remind you that there is one more session in this series. On May 13th is Mental Health and Wellness. It isn't too late to register, so tell your friends. The first 250 students to register will receive a self-care package in May. And we'd also like to share some resources with you. All these links are currently being dropped in the chat box as we speak.
Thank you all for attending this evening. We really appreciate it and hope that you enjoyed the presentation. We'll start the Q&A session in just a minute, so stick around if you would like. Thank you again for attending the Contra Costa County Student Wellness Series.
So if you have any questions, please put them in the Q&A box. We currently have no questions, so if you have any, there won't be too much of a wait until we get to yours.
And we're just going to go ahead and give a couple minutes and see if any questions come in.
Oh, looks like we just got one. So, an anonymous attendee asks, where can I go to learn about secured credit cards and how the deposit for these works?
So my recommendation would be that you figure out which financial institution you want to open an account with, or if you already have an account somewhere with a bank or a credit union, find out what their rates are, what their minimum deposits are, and they will sit down with you and explain it, like how it works, give you the whole run through. And that will be best because you will be building that relationship with them and be able to ask them that question. If you do want to come to Travis, like I said, the minimum is $250. So that's the lowest I think that you can find a share secured, and it goes up to 1,000. And so again, that would be the limit that you have available. And just keep in mind that you should only utilize 30% of your limit to maintain a good credit score. Great
Thank you,
question.
Jessica.
And if you want more information, you can also email me and I can help answer any individual questions before you go and do your shopping around for the share secure card.
Right, I don't see any other questions in the Q&A box or in the chat box. So with that, Cece, would you like to wrap us up?
And thank you, Contra Costa Office of Education, for inviting us to be part of this webinar series. Please keep us in mind for the next one, and also to your other program, TUPIC, that you guys are doing amazing work out there. So thank you. Thank you for having us.
Thank you.
Yes, Jessica, thank you so much for the wonderful presentation. Thank you guys all for being here. Have a wonderful evening.